Inflation is a general increase in the prices of goods and services in an economy over a period of time. It is a phenomenon that affects everyone, from consumers to businesses and even governments. Understanding how inflation works is essential for navigating the financial landscape. When the price level rises, each unit of currency buys fewer goods and services. This means that the money you have today will not stretch as far in the future. For instance, the cost of everyday items like groceries, fuel, and clothing can increase, making it more expensive to maintain the same standard of living. Consequently, inflation reflects a reduction in the purchasing power per unit of money, a loss of real value in the medium of exchange and unit of account within the economy. This devaluation can have widespread effects, influencing everything from personal savings to business investments. Inflation is a major concern for economists, policymakers, and consumers alike. It is a key indicator of economic health and stability. High inflation can signal an overheating economy, while low inflation might indicate sluggish economic activity. It erodes the value of savings, reduces purchasing power, and can lead to economic instability. For savers, this means that the money they set aside today will be worth less in the future, potentially affecting their financial security. Understanding inflation is crucial for making informed financial decisions. By keeping an eye on inflation trends, individuals and businesses can better plan for the future, adjusting their strategies to mitigate the impact of rising prices. For example, if the inflation rate is 2%, a basket of goods that costs $100 today will cost $102 in a year. This seemingly small increase can add up over time, significantly affecting long-term financial planning. This means that the same $100 will buy you less in a year due to inflation. Being aware of this can help you make better choices about saving, investing, and spending, ensuring that you maintain your purchasing power over time. Inflation plays a significant role in determining currency exchange rates. It is one of the key economic indicators that investors and traders closely monitor to make informed decisions. When a country experiences high inflation relative to its trading partners, its currency tends to depreciate. This depreciation occurs because the higher inflation rate reduces the currency's purchasing power more rapidly than that of other currencies. This is because the purchasing power of that currency is decreasing faster than that of its counterparts. As a result, goods and services become more expensive domestically, and the currency loses value in the foreign exchange market. Let's take the example of the British pound, GBP, and the euro, EUR, against the US dollar, USD. These currencies are often compared due to their significant roles in the global economy. If inflation in the UK is higher than in the US, the GBP is likely to weaken against the USD. This weakening happens because investors and traders anticipate that the higher inflation will erode the value of the GBP over time. Similarly, if inflation in the Eurozone outpaces that of the US, the EUR-USD exchange rate is likely to decline. Investors will move their assets to currencies that are expected to maintain their value better. This is because investors seek currencies with higher purchasing power and stable value. They prefer to hold assets in currencies that are less likely to be affected by inflationary pressures. High inflation erodes these factors, making a currency less attractive to hold. Consequently, currencies from countries with lower inflation rates become more appealing, leading to shifts in the forex market. Gold has long been considered a safe haven asset during times of economic uncertainty, including periods of high inflation. This is because gold is a tangible asset with intrinsic value, unlike fiat currencies which are not backed by any physical commodity. When inflation rises, the purchasing power of fiat currencies declines. In contrast, gold tends to retain its value or even appreciate as investors seek to preserve their wealth. Therefore, investors often turn to gold as a hedge against inflation. However, it's important to note that gold prices can be volatile, and investing in gold is not without risks. Central banks play a crucial role in managing inflation and maintaining price stability. They act as independent institutions responsible for setting monetary policy, which influences interest rates, money supply, and overall economic activity. One of the primary mandates of central banks is to control inflation. They aim to keep inflation at a target level, typically around 2%, which is considered healthy for economic growth. To achieve this, central banks employ various monetary policy tools, with interest rates being one of the most important. Section 5. Interest rates, a powerful tool against inflation. Interest rates are a key tool used by central banks to manage inflation. When inflation is high, central banks typically raise interest rates to curb borrowing and spending. Higher interest rates make it more expensive for individuals and businesses to borrow money, which can slow down economic activity and help bring inflation under control. Conversely, when inflation is low, central banks may lower interest rates to stimulate economic growth. Lower interest rates make borrowing cheaper, encouraging spending and investment. Central banks must carefully balance economic growth and price stability when adjusting interest rates. Section 6. Inflation expectations, a self-fulfilling prophecy. Inflation expectations refer to the beliefs of individuals and businesses about future inflation. These expectations can influence current economic behavior and, in turn, affect actual inflation. If people expect prices to rise significantly in the future, they may demand higher wages or increase their spending today. This increased demand can lead to higher prices, creating a self-fulfilling prophecy. Central banks closely monitor inflation expectations and communicate their policies effectively to manage these expectations and maintain price stability. Section 7. Market volatility, riding the waves of uncertainty. High inflation can contribute to market volatility. When inflation is unpredictable or rising rapidly, it creates uncertainty for businesses and investors. This uncertainty can lead to fluctuations in asset prices, including stocks, bonds, and currencies. Investors may become more risk-averse during periods of high inflation, leading to sell-offs in riskier assets and a flight to safety in assets like gold or government bonds. Navigating market volatility requires careful analysis, diversification, and a long-term investment strategy. Section 8. Navigating the storm strategies for investors. In today's volatile economic climate, it's crucial to have a well-thought-out plan to safeguard your investments. During inflationary periods, investors need to adjust their strategies to protect their portfolios and potentially profit from emerging opportunities. Inflation can erode the purchasing power of money, making it essential to seek assets that can outpace inflation. Here are some strategies to consider. Diversifying your investments can help mitigate risks and enhance returns. As mentioned earlier, gold is often seen as a hedge against inflation. Its value tends to rise when the cost of living increases, making it a reliable store of value. Other assets that tend to perform well during inflationary periods include real estate, commodities, and inflation-protected securities. Real estate can provide rental income and appreciate over time, while commodities like oil and agricultural products often see price increases. Value stocks represent companies whose shares are considered undervalued by the market. These stocks often have a lower price-to-earnings ratio and can offer significant upside potential. These companies often have strong fundamentals and a history of paying dividends, which can provide some protection against inflation. Dividends can offer a steady income stream, which is particularly valuable during times of economic uncertainty. Investing in foreign markets can provide diversification benefits and potential growth opportunities, especially if inflation is higher in your home country. Different economic conditions abroad can offer unique investment prospects. Keep abreast of economic indicators, central bank policies, and market trends. Understanding these factors can help you make informed decisions and anticipate market movement. Consulting with a financial advisor can help you develop a personalized investment strategy tailored to your risk tolerance and financial goals. A professional can provide insights and recommendations that align with your long-term objectives, ensuring you stay on track, even during turbulent times. Section 9. Bitcoin and inflation, a hedge or a gamble. Bitcoin has gained popularity as a potential hedge against inflation due to its decentralized nature and limited supply. Some proponents argue that Bitcoin's fixed supply, capped at 21 million coins, makes it immune to inflation caused by central bank monetary policies. However, Bitcoin's price is highly volatile and driven by factors beyond inflation, such as market sentiment, regulatory developments, and technological advancements. Additionally, Bitcoin's relatively short track record makes it difficult to assess its long-term effectiveness as an inflation hedge. While Bitcoin may offer potential diversification benefits, it's crucial to approach it as a high-risk investment and allocate only a small portion of your portfolio to it if you choose to invest. Section 10, Conclusion: Inflation and the Future of Finance. Inflation is a persistent economic force that impacts various aspects of our financial lives, from currency values to investment decisions. Understanding how inflation affects markets, central bank policies, and asset prices is essential for making informed financial decisions. By staying informed, diversifying portfolios, and considering inflation hedging strategies, investors can navigate inflationary periods and potentially mitigate their impact on their financial well-being. As we move towards an increasingly complex and interconnected financial landscape, understanding inflation and its implications will remain crucial for individuals, businesses, and policymakers alike.